What if the most important financial shift of this decade isn't happening where everyone is looking? Not in AI stocks, not in crypto rallies, not in meme trades, but in something ancient, silent, patient, gold, not exploding in headlines, not trending daily, but climbing steadily, structurally, strategically. And the silence is the signal. Because gold doesn't move when people are excited. Gold moves when confidence quietly erodes. Right now, beneath the surface of stable markets and optimistic headlines, the global financial system is under pressure. Government debt levels are at historic highs. Major economies are running persistent deficits. Central banks expanded their balance sheets dramatically over the last few years. Trillions were created to prevent collapse. The crisis was avoided. But the consequences were not. Inflation surged. Purchasing power declined. Living costs permanently reset higher. Even as inflation numbers cool on paper, prices haven't returned to previous levels. The damage is embedded. And this is where gold begins to matter. Gold is not a growth asset. It's a trust asset. When trust in monetary discipline weakens, gold strengthens. For decades, the global system revolved around the US dollar. Energy trade, commodity pricing, sovereign reserves, all dollar-based. That system created stability, but it also created dependency. Now that dependency is being questioned. After major geopolitical conflicts and financial sanctions, countries realized something critical. Reserves held in foreign currency can be frozen. Access can be restricted. Financial systems can be weaponized. And when that realization spreads, diversification begins. Groups like BRICS have openly discussed reducing reliance on the dollar system. This is not an overnight revolution. It's a gradual hedge. Gold becomes central in that hedge. Because gold has no counterparty risk. It is not issued by a government. It cannot be printed. It cannot be sanctioned. It is politically neutral collateral. That neutrality is becoming extremely valuable in a fragmented world. Now look at what central banks are doing, not what they're saying. They are buying gold at one of the fastest paces in modern history. Think about that. The institutions that create fiat currency are aggressively accumulating the one asset that competes with fiat. They understand something retail investors often ignore. Monetary systems move in long cycles. When debt expands too far. When interest expenses consume budgets. When growth slows but obligations rise. Policy flexibility shrinks. Governments face a dilemma. Keep rates high and risk recession. Cut rates and risk currency weakness. Gold thrives in that dilemma. Because gold performs best not during prosperity, but during uncertainty. And uncertainty today is structural, not temporary. Energy systems are being rebuilt. Supply chains are being regionalized. Defense spending is increasing globally. Demographics in developed nations are weakening labor supply. These forces are inflationary over the long term. Even if headline inflation dips, structural cost pressures remain. And here's the key dynamic markets are slowly pricing in. If growth weakens meaningfully, central banks will eventually have to ease policy again. But easing into a high debt, structurally inflationary environment weakens currency purchasing power. That's gold positive. Another layer most investors overlook is technical structure. Gold spent years consolidating in a broad range. Long periods of sideways movement build energy. They create accumulation zones where strong hands quietly position. When price breaks out of multi-year resistance, it signals institutional rotation, not speculative frenzy. Explosive moves are rarely loud at the beginning. They begin quietly. The psychology of a gold bull market follows stages. First, disbelief. Gold is outdated. It doesn't produce yield. It's dead money. Then comes early adoption by institutions. Then acceleration. Then media excitement. Then euphoria. We are not in euphoria. Not even close. Retail ownership remains modest. Mainstream narratives focus elsewhere. Sentiment remains cautious. That's the foundation of sustainable upside. Meanwhile, the broader financial system is increasingly leveraged. Governments roll over massive debt loads annually. Corporations depend on refinancing at manageable rates. Banking systems rely on stable liquidity. Any shock, geopolitical, credit-related, or growth-driven, can force policy reaction. Gold doesn't require collapse to rise. It requires fragility. And fragility is rising. Consider the scale of sovereign debt globally. Servicing that debt becomes more expensive when rates stay elevated. If economic growth slows while interest burdens remain high, fiscal pressure intensifies. Eventually, policymakers prioritize stability over currency strength. Historically, that shift benefits hard assets. Gold acts as a monetary hedge, not against one event, but against policy cycles. There's also the issue of real interest rates. Gold tends to perform strongly when real rates decline or turn negative. If inflation stabilizes above target while central banks cut rates to support growth, real yields compress. That environment is historically bullish for gold. And markets are beginning to anticipate that possibility. Quietly. Another overlooked factor is reserve diversification. Emerging market central banks are gradually increasing gold allocations. This isn't ideological. It's strategic balance sheet management. Diversification reduces vulnerability. And when multiple countries diversify simultaneously, demand compounds. Unlike fiat currency, gold supply grows slowly. Mining output expands marginally each year. Large increases in demand cannot be quickly met by production spikes. That imbalance supports price appreciation over time. Gold also benefits from declining confidence in long-term fiscal sustainability. When budget deficits become chronic rather than cyclical, investors begin seeking stores of value beyond government bonds. Traditionally, bonds were considered risk-free. But when debt levels surge and political polarization complicates fiscal reform, even sovereign debt carries perception risk. Gold fills that psychological gap. It's not about fear. It's about preservation. Throughout history, during transitions between monetary regimes, gold has reasserted itself as a stabilizing anchor. We may not be witnessing a dramatic overnight reset, but slow transitions often have the greatest impact. Wealth preservation isn't about reacting late. It's about recognizing quiet shifts early. Gold is not screaming higher. It's grinding higher. That grind is more powerful than hype-driven spikes because it reflects structural demand, not speculative mania. When, and if, gold dominates front-page financial news. When mainstream analysts unanimously turn bullish. When retail participation surges dramatically. That will likely signal later stages of the cycle. Right now, the move remains underappreciated, which is why it matters. So why is gold quietly exploding? Because debt levels are historically high. Because geopolitical fragmentation is increasing. Because central banks are diversifying. Because structural inflation pressures persist. Because policy options are narrowing. Because trust in long-term monetary discipline is softening. Gold rises when systems stretch. And today, the global system is stretched. The silence isn't weakness. It's accumulation. And by the time the explosion becomes obvious, it won't be quiet anymore.